All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. In this video, I want to talk to you about what's going on with interest crediting rates over the last 5 years. This is important because a lot of you that have existing policies are seeing interest rates that are extremely low. You might be unhappy with those, while people that got new policies are seeing a little bit higher rates. And I want to explain what's going on and why you're seeing that. And frankly, you can make your own decision on whether or not the insurance companies are doing right by you. So if that sounds interesting, stick around and I'll dive right into it. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. My business is all about designing maximum overfunded life insurance policies that can be leveraged for investing in real estate. Or at the same time, they could also be leveraged for tax-free retirement income. If you notice, the background's a little different. I'm on vacation right now in Mexico. I just thought I would do a video on the subject of what is going on with interest crediting rates right now. I know this is top of mind for a lot of clients out there. So what I want to do is explain the insurance company's responses to the changes in interest rates over the last 5 years or so, since 2020. And we're going to do that by just taking a look at interest rates in the general economy. As usual, my disclaimers: life insurance, the purpose of life insurance is for death benefit protection. Any other benefits, such as leveraging it, is purely ancillary. Also, this is purely educational. There's no tax advice, no legal advice, no financial advice. This is all just information on how life insurance works. All right, so the agenda for this presentation is just to look at interest rates in the economy from 2020 to 2025. I'm going to show you a graph with much more information than that on it, though. But this is what we're going to be talking about. And then I want to talk about the insurance company's response. Some did nothing, and some segmented their reserves. And I'll explain exactly what that means when we get to that. Then I want to give you my thoughts, and then we'll wrap things up. All right, so here is a graph of the Moody's corporate bond yield over the last almost 100 years, going back to 1920. And you can see that, in the period leading up to 1979-80, the Federal Reserve got off the gold standard, started printing money, and we saw interest rates and inflation and stagflation in the economy. In about 1980, the Federal Reserve got control of interest rates, and we saw pretty much a 40-year decline in interest rates. A little volatile, but a steady decline in interest rates leading up to 2020. And the worldwide pandemic at that time led to the Federal Reserve and around the world, not just in the U.S., slashing interest rates to try and stimulate the economy, keep the economy going in light of people not working and everything. So since the end of the pandemic, we've seen interest rates recovering. So the question you guys have, or my clients, my policy owners, if interest rates are going back up again, why am I seeing low interest crediting rates on my policy right now? And that's what I'm hoping to address in this video. All right, so again, rates dropped to all-time lows in 2020. And pretty much every company that had issued bonds would have taken the opportunity as rates were coming down to refinance those bonds. So what that meant for the insurance companies is all of the bonds that they hold in their portfolios, the bonds that had the highest interest rates were likely to have been called, and then the company would have reissued the debt at lower market-based interest rates. So by 2020, insurance companies' reserves were earning all-time lows just as well as the interest rates had come down. Now, when interest rates started going back up again, you're probably wondering, why didn't the interest crediting rates and dividend rates follow the rise in interest rates? The best way to explain what's happening with interest rates is to think of the insurance company's reserves as a big swimming pool that's sitting at 75 degrees. That's as low as it got during the fall or late summer. And if the homeowner wants to increase the temperature of the pool, I want you to think of what the impact would be of just taking a gallon of boiling water and pouring it into a large backyard swimming pool. And if you do that, you can imagine that barely made an impact on the temperature of the pool. And at the same time, if you had a separate pool and you filled it up with boiling water, you would have a very hot swimming pool. And the reason this is a good analogy is all of the insurance company debt that they were holding in their reserves at the time was at low interest rates. So the only thing that's going to impact the overall interest rate that the portfolio is earning is the new money that's flowing into the life insurance policies. And these are new policies that are being written, or policies that the bonds mature and the cash is being reinvested in bonds at current interest rates. But nonetheless, you can get the idea that it's going to take a long time for rates to go back up again on an overall basis. Now, this impacts all insurance companies. This impacts the whole life, or companies that specialize in whole life. Because again, there's no difference between an IUL company and a whole life company. Whole life companies also have universal life and index universal life products. So all of the reserves are invested in the bonds. So changes in the interest rates of the overall portfolio impact dividends on whole life as well as interest crediting rates on IULs. So this really left insurance companies with two different options. If they kept interest rates low, it makes life insurance a very unattractive product for new customers. At the same time, it just takes time for those interest rates to come up, so current customers are suffering too. And what a lot of companies did was nothing. They just left their rates low and they're dealing with it. They feel like that's the best response for their clients. But a lot of other clients, insurance companies, segmented the reserves. And what I mean by that is they literally cut out or carved out a separate segment of money that was allocated to just the new policies that they were selling. And that's what I mean by a second swimming pool, that you're pouring boiling water into it. So the interest rates and the interest crediting rates on that pool are amazing, as the interest rates have gone back up in the economy over the last 5 years. However, that meant very little to no new money flowing into the old policies. So the only turnover there would be new cash of bonds that mature being swapped, the cash from that being used to purchase new bonds at higher interest rates. And you can see that would take a long time to have a significant impact on interest rates. But to be fair, that this is one reason why life insurance companies were able to offer such good dividend and interest crediting rates during the years that interest rates in the general economy got lower and lower and lower. They held portfolios of long-term bonds that had good yield to maturity, so they weren't as impacted by low rates. But over time, it trickles down and it does have an impact. All right, so my thoughts on all of this. I can't help but think it's a really shitty move for insurance companies to have done this to existing policy owners. But at the same time, I understand that they're a business and they need to drive new clients to keep the company afloat. So I've got very mixed feelings on it. This is all great for new clients, but older clients with existing policies, you're not in a position where those policies are going to perform optimally or anywhere near as good as policies that are being issued right now. So you're faced with a decision of hanging on to that policy or potentially replacing it with a new policy with new interest crediting rates. And that's really the only two options that you have. So that's really all I have for this video. I just wanted to explain what's going on. Hopefully it all made sense to you. And I look forward to seeing you in the next video.